Okay, let's jump right in. If you're looking at the financial markets right now, it can feel like you're watching two totally different shows at the same time.
It's a perfect way to put it. You've got this dual axis market. That's really the theme for today's deep dive.
The dual axis, so two distinct forces pulling everything in different directions.
Exactly. On one hand, you have the Fed managing short-term liquidity, the system's plumbing. And on the other, you've got these wild event-driven swings in places like tech and crypto.
So let's start with that foundation, with the Fed. It's not the usual rate hike talk, is it? Our sources are pointing to something more, I guess, technical.
Right. It's all about what the New York Fed is doing with something called reserve management purchases, or RMP.
RMP. What is that in simple terms?
Think of it as a very precise injection of cash. They're buying short coupon securities.
Short coupons, so short-term government debt.
Yep, stuff that matures quickly. The plan is to buy about $40 billion worth in the first month. It's not about stimulating the whole economy, it's just about making sure banks have enough reserves to keep the system running smoothly.
So it's a technical move, but it has a huge impact.
A massive impact. It anchors the short end of the interest rate curve. That's why we're seeing the 2-year Treasury yield staying relatively low, around 3.5%.
Yeah.
The Fed is basically managing any immediate risk of a cash crunch.
Okay, so the foundation is being managed, it's being stabilized. But on top of that, you have this completely split personality when it comes to risk.
Oh, it's a huge split. If you look at the VIX, the so-called fear index for stocks, it's pretty calm.
Right, it's hanging out around 16 or 17. For the S&P 500, that suggests things are, relatively stable.
Stable, exactly. But then you look at the crypto world. The crypto fear and greed index is also at 16. But there, that number means extreme fear.
Wow. So the same number, but a completely opposite meaning. One is calm, the other is panic. Why the huge difference?
It really comes down to leverage. The crypto market is just exceptionally fragile right now. Any little dip can trigger these cascading liquidations because so many people are over-leveraged. So even with Bitcoin trading high near, say, 88,000, the underlying mood is just terrified.
So that's the event-driven volatility you mentioned. Let's talk about a specific driver. I'm guessing NVIDIA is at the top of that list.
Always. NVDA stock is swinging wildly between maybe 175 and 185, and the reason is all about these reports, these rumors about its H200 chip.
And this is about China, right?
It's all about China. The idea is that NVDA might increase production to meet Chinese demand. That would be huge for revenue, but it's completely tangled up in regulatory uncertainty. Will the U.S. government even approve it?
So the stock price is basically a bet on government policy.
It's a perfect policy barometer, and you see a similar thing in crypto, actually.
But I thought crypto was an extreme fear.
It is, overall, but specific news can create these little pockets of optimism. Like, Circle got a financial license in Abu Dhabi for its USDC stablecoin. That's a huge win for them.
A structural win.
Exactly. Or look at Coinbase, restoring services in India. That's a massive growth signal. So smart money can still find these opportunities even in a fearful market.
Speaking of smart money, our sources flagged a really high-risk area we have to mention. These things called pre-stocks.
Yes, this needs a major warning label. These are basically tokens that are supposed to represent shares in private companies like Anthropic or XAI before they go public.
That sounds incredibly risky.
It is. The liquidity is often paper thin, meaning one big sell order can crash the price. If you're even thinking about touching these, you absolutely must do your homework. Verify the contract, verify the liquidity, know how you're going to get out.
So let's tie this all together. We have the Fed providing a stable floor with RMP, but on top of it, we have this chaos. How should you navigate this?
The main advice is risk control. You have to stay flexible. For broad market stuff, like a VOO or QQQM, dollar cost averaging is the way to go. Don't chase these rallies.
And for the headline-driven names like NVIDIA,
you treat it as a message-driven trade. You don't bet the farm on a rumor. Wait for real confirmation, like an official approval or, actual order numbers.
It all seems to come back to that technical tool from the Fed, the RMP.
Yeah.
You mentioned it's a technical adjustment, but it feels like the whole market is hanging on it.
It is, and that leads to the final, I think, most important question you should be thinking about.
What's that?
It's about the Fed's real intention. There's this huge debate happening right now among institutions. Is this RMP thing just a technical plumbing fix, just managing their balance sheet?
Right.
Or does it represent a real, if subtle, change in monetary supply? Is it a quiet form of stimulus?
So is the Fed just tightening a bolt, or are they quietly installing a whole new engine?
Exactly. And how the market decides to interpret that, well, that is going to determine where we go for the next